Inflation data for the US came in today cooler than expectations, signaling that we may be winning the war against high inflation. This in turn should allow people to feel like they have a little bit more breathing room than just the past year or two. While this could be something to celebrate about, it seems like the effects of high inflation and what has happened over the last 2 years is yet to fully been felt yet. While the S&P 500 continues to surge, the first ever special rebalance needs to be made to the Nasdaq 100 to accommodate for just 7 companies holding up the entire stock market. On top of that, when we look at the strength of the dollar, it's heading in the wrong direction, which isn't good for anyone holding the US dollar, and things don't look too good when you look on the consumer side of things, especially when you look anywhere in terms of debt, because anywhere we look, it looks like we're reaching the highest levels of debt in every area of our lives, all the way from credit cards to student loans to car loans and housing payments as well. Welcome back to the channel. I hope all of you are having a great day. If you're brand new here, our whole goal with this channel is to try to help you understand what's happening in the financial markets without all of the useless jargon and try to simplify things as much as possible. And before we get into the video, I do want to urge you guys to watch it all the way through, as there's a lot of important data that we go into to make sense of this entire video and the title and everything like that. So the first thing that I want to get into is that inflation came in today below expectations, showing that it was a little bit cooler. CPI inflation came in at 3% and the estimations were around 3.1, core CPI at 4.8 when the expectations were 5. Now you could see that the US inflation rate slid to a more than 2-year low, which is a major step toward ending the cost of living emergency that we've been living with for the last year or two. And this could possibly urge the Fed to stop its historic monetary tightening as well. Now you can see back here when we had the height of our inflation problems, all the way back in June of 2022 when we had CPI inflation at 9% and core at 5.9. Now, one of the struggles we've had is that while we've brought down CPI year over year from 9.1 all the way to 3%, which is a really big decrease in CPI inflation, the problem is that core inflation has only come down 0.9%. And this is a major thing that the Fed looks at. So when we ask ourselves, yes, inflation is coming down, but is that enough to basically urge the Fed to stop tightening? And when we look at the possible target rates for what the Fed is going to do, if they're going to raise interest rates or not, currently we're sitting at 5% for interest rates. And you could see that by July, or this next coming FOMC meeting coming July 26th, it seems like they are going to raise by 25 basis points. But if we go ahead and take a look a month out to September and November, you can see that most of the estimations that people are making is that we're only going to raise rates one more time. As you can see, there's an 80% consensus that we're just going to stick at 5.25% for our interest rates, or the federal fund target rate. If we go out to November, you can see that that's also the majority vote. So if inflation is coming down and it continues to come down month over month and year over year, is that going to be enough for the Fed to just raise one more time? Now, when we take a look at the short-term yields, right now we're looking at the 2-year yield percentage. Whenever this is going down, that shows a little bit of optimism in the short term for the Fed, because as the yields come down in the short term and the equity markets are rising, that's showing that people are going to be a little more risk on for their assets, which is good for the economy and good for risk assets. But one thing I wanted to take a look into is the S&P 500 on the weekly, daily, and 4-hour, and to help you understand where we might be going short term, but also the macro view of this and why it's important to understand all those time frames. Now, on the weekly, obviously you can see that we've had so much strength in the S&P 500 all the way down here. From March of 2023, we have just been on a rocket ship, rising over 17% in the markets. Now, this is very impressive for the S&P 500, especially when you look at the macroeconomic concerns that have been looming all around. When you look at this chart alone, it doesn't seem like anything has been wrong in the economy. One thing that I want to zoom in on is the strength of these candles. Whenever we push up in the markets, as you could see by these green candles, we have a minor retracement and immediately a bullish engulfing, showing massive strength in the markets. Again, right here, last week, we had some of a minor retracement, and we still have 2 days until the markets close, but it's looking like we're having another bullish close in the markets, signaling more strength to the upside. And I personally think that in the short term, we could reach this weekly resistance of 45.45 in the S&P 500, which you could see in the past has been very strong resistance over here in the past year. Now, if we go ahead and zoom in a little bit on the charts, you can see that we have broken out to relative highs. The last time that price was this high was all the way back in the late April 2022 stage. Now, this is very important, especially when we drop down to the 4-hour. But again, you can see the surge in price showing this upper trend line. And as we continue to make pushes to the upside, we have minor retracements, and then we continue to push. Now, it was very important because we were stuck at this resistance level, but obviously we gapped up and came to all of these relative highs that we're sitting at. Now, while I think in the long term we could reach this weekly resistance, I think it's going to have some choppiness. I think what we could see is something like this, but I think eventually the end target is this weekly resistance at 45.45. Now, when we go into the 4-hour chart, one really important thing I want to look at is kind of what we've seen in the past, because typically what happens in history, it doesn't exactly repeat itself, but it often rhymes. And what you could see is that once we had a massive surge in terms of price back here in March and April, we consolidated for a decent amount of time from April to basically right around here in May. So almost 2 months of consolidation where price just basically went back and forth in between this level right around here until it broke out, retested that consolidation zone, and then shot back to the upside. Now, what we're seeing is basically something very similar where we had this shoot up in price. We consolidated for a little bit, and it looks like we're breaking out of this consolidation zone. Now, if we do drop back into it, obviously I think we could continue to consolidate, but I think at the end of the day is we're going to have a good close to the upside, a retest, and I think we're going to ultimately reach this weekly resistance zone right here at 45.45 in the short term, at least for the S&P 500. Now, that kind of comes to the long term of this, right? The stock market in the past, basically year to date, the last 6 months, has been driven by the Magnificent Seven, right? 7 stocks have basically driven the entire stock market all the way up to its mega gains. And so due to this, the rebalance, or what the NASDAQ is going to have to do, is they're going to have to take a lot of that influence away from Microsoft, Apple, Alphabet, Nvidia, Amazon, and Tesla. And doing this is going to hurt those stocks in terms of their price as they're going to drop it. And obviously it's going to boost basically all of the other 93 companies in the NASDAQ 100 and obviously the S&P. But I think in the long term, if you're taking away a lot of the gains, or, these companies are producing a lot of the gains in these index funds, if you take that power away, what I think in the long term, what we might see is a little bit of a drop. So yes, I think in the short term, we could reach this weekly resistance because of the cooling CPI data that's coming in. But I think once this rebalance happens at the end of July 24th, that's when you could see these stocks start to fall a little bit more, and maybe the S&P 500 fall back into this consolidation zone once we do break out to the upside. Now, one really important thing that we have to look at is the split between the S&P 500 and what analysts are saying. Now, what we're seeing is that the highest predictions say that we're going to go to 48.25, and the lowest predictions say that we're going to reach 32.25 in the S&P 500 by the end of the year. Just to kind of show you what that means for comparison, if we're just talking about price as of right now, if we go to 48.25 right around here, that's about an 8% push to the upside by the end of the year, which would actually reach us to new all-time highs, breaking them all the way back here. That's an extremely optimistic view of the end of the year predictions. Now, if we go back all the way to the lows, which is the lowest predictions on record that we have, some analysts think that we're going to drop at least 27%. Now, that's the most pessimistic view. But the thing that I want you to get away from this is that nobody really knows what's happening, and we have some of the biggest splits in the S&P 500 dating all the way back to the early 2000s. Some people are very optimistic to the upside, and then we have our bears, which are very to the downside. And as of right now, it looks like a 50-50 split. Now, you can see that the problem that the S&P 500 and the NASDAQ 100 have been having is that the 6 best companies have accounted for 51% of the influence on this, meaning that their shares are going to have to come down to at least 40%. So while all of these companies are going to take a hit around July 24th in terms of their price, you can see right here how impressive just these 6 companies have been year to date or over the last 6 months. And when you take a look at the stock market, it's showing kind of like a false hope where 6 to 7 companies have basically brought up the entire economy in terms of the market. But when you take a look at everybody else and all the other companies, they're basically just flatlined and have provided no gains whatsoever. And this is a very important metric that I think we need to understand as well. When we take a look at the Wilshire 5000, which is the broadest index fund in the United States, you can see that the concentration of stocks has never been higher. If we look back to the 2000.com bubble, the top 10 stocks accounted for around 20% of basically 5,000 other stocks, which is insane to think about. But now we have a larger concentration sitting at 26%, meaning that the top 10 stocks have around 26% of the influence in the Wilshire 5000. And you got to remember, there's 5,000 other mega or just massive companies in this entire index. And just 10 of those have 26% of that market cap. And when talking about gains in terms of US dollars, one thing that I want you guys to remember is that you have to ask yourself, is your portfolio going up or is the currency you're holding it going down? Because if the dollar index or the power of the dollar is going down, then all the assets compared to it are going to go up. So let's say Bitcoin, for example, it's either Bitcoin's value is going up or the US dollar's value is going down. It's one or the other. That's the same for these stocks as well. If the assets are going up and yet the dollar is losing value compared to everything else, you have to ask yourself, are you actually making money at the end of the day? And just this past week, you could see that the US dollar has been falling off of a cliff, keeping these lows that we've basically kept for the past few months, really. And I think if this weekly candle holds, what we could do is fall back to this resistance or support zone that we've seen all the way back here that started pre-pandemic in 2019, right around here. Now, here's the big reason that I'm talking about the US is still in trouble. They still have big problems that they need to fix. If we look at inflation alone, it looks like the US is winning the war against inflation. The S&P 500 is surging. But again, when you look at the dollar index, it is falling off a cliff. So you have to ask yourself, well, yes, the S&P 500 is rising. The currency that you're reverting back to is losing value. So you have to ask yourself, are you actually making as much money than you think? And on top of that, the United States and all its consumers are having a massive debt problem, meaning that anywhere you look, people are accruing way more debt than they can actually handle. And on top of that, with rising interest rates, that debt is more expensive than it was just a couple of years ago. Just for example, if we look at credit cards and the credit card interest payments, you could see that basically since the pandemic, or really 2021, right around here, credit card debt in consumers has continued to rise, basically hitting an all-time high of $1 trillion. So out of everybody in the United States, there's over $1 trillion in credit card debt. And to make matters worse, when you look at the interest rate on those credit card plans, it has also been rising. So while these credit card companies like Visa and MasterCard and Discover, while they're raking in a ton of interest payments on these consumers, a lot of people who have massive amounts of credit card debt also have some of the highest interest payments as well, above 20% on average. Now, this is also a massive problem because when you turn your head over to student loans, obviously Joe Biden's student loan program got denied. So now these people who have massive amounts of debt, not only in their credit cards, but their houses, their cars, they're also going to have to start paying back their student loans, which on average is going to be $400 a month, which if you look at the average consumer or the average American, that's a lot of money. And again, while inflation is coming down and the fight, against the recession looks like we're going to have a soft landing, when you look at the months from the first inversion to the first recession happening, we still aren't at the peak. Typically, the peak happens around 12 to 13 months out, and currently we're just sitting at around 7 to 8 months. So there's a lot of lag time between when we see massive amounts of unemployment happening and when the recession actually starts. And when you look at the average, typically it happens around 12 to 13 months. So employment or unemployment will start to rise right around that time frame, and that's when people typically feel the most pain. And again, we're still at least 4 to 7 months out from that. So by the end of 2023, start of 2024, that's maybe when we could see, according to this chart, unemployment will start to rise. And that's typically the last leg or indicator for a recession to start. So it'll be really interesting to see how these next 4 to 7 months play out in terms of this chart. But that's everything I have for this video. I hope you guys enjoyed it. I hope you found some value from it. If you did, make sure to subscribe and like the channel. We really appreciate all the support. And until the next one, we'll see you guys then.